Oui, bonjour à toutes, bonjour à tous. Merci d'être venus. C'est la seconde fois qu'on organise ce type de rencontre entre Patrick et Bob. Et on est très content de les avoir. On est également très content de notre collaboration avec Barclays et Natixis dans l'organisation de cet événement. Je vais être très bref. Je signale simplement, certains d'entre vous certainement assisteront à la conférence UNPRI, donc principe pour un investissement responsable. Donc c'est la plus grande conférence mondiale sur le sujet de l'ESG. Et cette conférence débute dans peu de temps à Paris, et donc je pense que pas mal d'entre vous y assisteront. Ce que je voulais donc simplement signaler, c'est que, et ça va être les 15 secondes de Product Push, on a élaboré avec Barclays et le professeur Shiller une stratégie qui est ESG et low carbone, qui est similaire à la stratégie qu'on a lancée il y a maintenant presque 5 ans, et qui surperforme, enfin cette stratégie ESG low carbone surperforme la stratégie historique. Je ne dis pas que c'est la preuve absolue que c'est possible, mais en tout cas, c'est un élément qui, pour ceux qui le font de gré ou de force, qui investissent dans l'ESG, je pense que c'est quelque chose qui vaut la peine d'être signalé. Voilà. Est-ce que c'est la self-fulfilling prophecy? Je ne sais pas, mais en tout cas, c'est quelque chose qui fonctionne aujourd'hui. Voilà. Estelle va maintenant présenter le panel. Donc Estelle, c'est à toi.
Merci Bruno. Donc, je représente aujourd'hui et je vous remercie vraiment chaleureusement de votre présence nombreuses et nombreux pour cet événement de rentrée et dans ce lieu quand même magnifique qui est l'hôtel Péninsula. Nous sommes ravis de vous accueillir et je vous accueille au nom de toutes les équipes commerciales de Natixis Investment Managers et d'Ossiam. Pour ceux qui connaissent un petit peu moins bien notre groupe, Natixis Investment Managers est une plateforme qui représente 24 affiliés. Ossiam est l'un de ces 24 affiliés. Et j'ai derrière moi le grand logo qui fait le lien de toutes ces sociétés de gestion Active Thinking. Pourquoi Active? C'est un très bon exemple autour d'Ossiam. C'est de la haute conviction qu'on vous offre. Ce n'est pas de la gestion classique. Et donc, dans l'exemple que soulignait Bruno, typiquement, justement, d'aller rechercher chaque fois de nouvelles idées, on est vraiment dans cet active thinking, chercher plus loin. Ce partenariat avec Barclays, avec le professeur Shiller, est un exemple. Ossiam a également lancé de nouvelles stratégies ultra innovantes sur, par exemple, l'ESG Machine Learning, sur des steepeners sur la courbe US, donc tout un tas de solutions. C'est vraiment un de nos affiliés extrêmement innovants et à la pointe. Et donc moi, j'ai le plaisir de vous présenter les speakers de ce matin, des personnalités fortes. Je vais commencer par Patrick Artus. Je ne sais même pas s'il faut encore vous présenter, Patrick. Donc Patrick est le chef économiste du groupe Natixis. Il est également présent au Paris Economics. Et il est également aux côtés d'Ossiam depuis presque 10 ans, membre du comité scientifique. Professeur Shiller, bien évidemment, prix Nobel, professeur à Yale, et je dirais gros partenaire d'Ossiam dans ce magnifique succès des fonds Case Shiller, et Esty Dwek, qui est notre stratégiste de l'équipe Solutions chez Natixis Investment Managers. Je vous propose de venir sur scène. Merci à vous et très bonne matinée à toutes et à tous.
I think we're probably going to switch to English.
We better.
Good morning, everyone. Thank you very much for being with us. There are a lot of risks out there, a lot of concerns, a lot of questions about what is happening in the markets. Are we at the end of the cycle? What could lead the next downturn? But I think before we dive into all those risks, maybe the first question for both of you is, where do you see good news right now?
Well, I guess I'm not in the habit of focusing on good news. We we have attentive central banks around the world. There isn't warlike sentiment. There seems to be something of a spirit of cooperation. Our President Trump may be highly critical and aggressive at times, but there's a warm side to him, which I hope you'll try to see as well. I'm sorry, I can't do a lot better than that.
That was positive enough. I'll take it. Patrick?
Yeah, on the same line, I think very clearly central banks and governments have an extreme aversion for recessions. It started 10 years ago. You understand why. A recession means a banking crisis, a social crisis, populism rising. And I think this is very important. As a consequence, we have zero rates. I think we'll be back to that afterwards. I mean, what it means, what it does to the economies. Now, something I think which is very important and which is very often forgotten in what I read, especially in the media, for instance, is that when you've got zero rates, everyone stays solvent. You cannot be unsolvent. You cannot be in a position not to be able to service your debt if you don't have to service anything. Yeah? So zero rates means solvency, including for those with very high debt and very high leverage. And so when you look at the cyclical developments, what you've got to exclude is something like a recession caused by a category of economic agents becoming unsolvent. And this is what started recessions in the past. In 2000, it was corporates. 2007, it was the American households with their mortgages. 2010, it was peripheral countries in Europe. Then it was EM in 2013. So in all instances, what started the crisis was a big group of people becoming insolvent, and this cannot happen today. It might be bad news because you're creating a huge moral hazard if everyone is insured by central banks, but it's excluding the kind of crisis we had in the past.
Well, if we're on the topic of central banks, we have, so you said and both of you have said you should see cooperation. Central banks are going to keep helping the economies. Markets are pricing in extremely aggressive new monetary policy. We have the ECB next week and the Fed next week. Is the market already pricing in so much that it's going to be difficult for the central banks to be effective? Maybe Patrick, do you want to start with that?
You say the market pricing in expectation. I have a more behavioral thinking about the market, and I'm not sure that that's exactly what's happening. I have a different narrative I can throw out, and that is that zero interest rates are a symptom of secular stagnation. And the narrative for that is the Japanese experience in the 1990s, which we all remember. Japan in the 1980s looked like the strongest economy in the world. It was taking over automobiles, cameras, high tech of all sorts. And then something happened, and the interest rate hit zero in Japan, and they had what was called originally the lost decade. They seemed unable to climb out. So I think that created a narrative now for our central banks. By pushing to zero interest rates, it paradoxically may not have stimulated because it enlivened that narrative. We now think that we're all going through repeating the Japanese experience.
Yes, we are seeing
So
a lot of those.
I think it may not have been good to go all the way to zero with interest. I call that the Z word, or even beyond zero, because it looks like an act of desperation. And I think maybe if they'd left, the central banks had left them a little bit positive, it might have actually been better.
So you don't really agree with Greenspan saying U.S. rates are going to go to zero as well?
It depends on the Federal Reserve, but the long rates are not a central bank, something that the central bank can send. And so the U.S. 10-year rate is about at zero in real terms, but the public doesn't think in real terms, which is in most of them, which is most people are not economists, and they look at this as fundamentally different from the Japanese experience, but I'm not sure that it is. I think the secular stagnation narrative is strong in the U.S. and it could get stronger.
Yes, two things here. There's a lot of academic research on the causes of very low long-term interest rates, because you've got many possible ideas. One idea is that there will be too much savings at the world level, implying too much demand for safe debts. And the rest, of course, the second idea mostly is that we have low rates because of central banks and very expansionary monetary policies. 90% or even more of this research ends up with the conclusion that it's mostly the behavior of central banks, which explains very low long-term rates. That it's very hard to find an explanation coming from savings, for instance. So let's assume that what we see is the effects of this very expansionary monetary policy with very low short-term rates. Then here are two questions. One, I think afterwards perhaps we can go to the list of the very negative consequences of keeping rates at such a low level for a very long period of time. Just finished a piece yesterday. I could find 14 different bad consequences of low rates. I mean, and only one good consequence. So basically, low rates lose by 14-1, which is something we should have in mind. But I think answering your question, I think on top of that, I completely agree with Bob, and I will state that perhaps a bit differently. Central banks have been losing the fight against capital markets. If you look at the past, for instance, in the US, in most instances, capital markets are wrong when they form an expectation of central banks' future behavior. So there is no good expectation by investors of what central banks will do, and then investors have to correct their expectations. For the first time, we might see the power shifting to capital markets, meaning that this time it would not be the capital markets adjusting to what central banks actually do. It might be central banks forced to do what capital markets expect central banks will do. And I think this is because central banks have not communicated sufficiently or sufficiently clearly on the fact that at some stage capital markets go in the wrong direction. We have not heard Jay Powell telling, I will not drive the federal funds rate to 1%, which is what the markets expect for next year. We have not heard the ECB telling, I will not cut by 40 BPs the deposit rate, which is what the market's expecting. And then the markets are confirmed this expectation by the absence of reaction of central banks. And now, what if central banks don't deliver what the markets are expecting? You're starting a big correction on long-term rates, a big correction on equity markets, which central banks will very likely want to avoid. And then basically they will be forced to do what the markets want to do. I think this is extremely dangerous to be in this causality. Basically the markets cause central banks and not the other way around. And this is maybe what you are seeing more and more. And just a last thing on yes. I'm fascinated, by perhaps something you have an idea about on neo-Fisherism. Neo-Fisherism, it's a very interesting theory. It's not a bizarre theory like MMT, so you have heard of. Neo-Fisherism is telling, in the long run, what determines inflation is nominal interest rates. It's just a Fisher equation. Got nominal rates. We should have a board to write like at university, but nominal rates equal real rates plus inflation. In the long run, real rates come from the economy. It's the marginal productive capital, whatever. So in the long run, nominal interest rates determine inflation. So if you keep nominal rates at a very depressed level, in the long run, you're causing less inflation and not more inflation. Inflation has to follow nominal rates. So basically, it means that central banks are the cause of low inflation because they kept nominal rates too low for a too long period of time. In the short run, of course, if you cut nominal rates, real rates come down and you support the economy. But this cannot be the case in the long run. Another way of telling is Bob's narrative, saying that central banks are passing a very negative message on the economy, telling to the people, we are worried about the future, growth will not recover, inflation will not recover, so everyone becomes pessimistic and starts to adjust inflation expectations down. But the way to have a theory around that is really neo-Fisherism, and neo-Fisherism, I think we have to keep in mind. If you don't want to believe Of course, when we explain that to the ECB's event, that keeping low rates for a long period of time causes lower inflation, because the message is we keep low rates and we'll do even more in 2 days because we want more inflation. When you start telling them, okay, if you cut rates in 2 days, you will have even less inflation. So of course, they don't like the idea at all. But if you don't like the idea, you've got to try to explain how you end up with nominal rate equals real rate plus inflation in the long run. So I think there is, for a different reason probably compared to what Bob just mentioned, I think there is a real possibility that central banks could be the cause of low inflation continuing.
I thought that was the Erdogan theory of...
No, Erdogan is the only politician adopting that, yeah, but it's not a reason for the theory to be bad. Huh?
Yeah, I think the problem is that it is a narrative that you describe, and the narratives are complicated studies, object of study, which they're so varied and so hard to pin down. But part of the Japanese narrative from the 1990s is that they couldn't raise inflation. They put in, so that was an example that supports your neo-Fisherian model. And that's a vivid example. People don't, the Japanese story is taken as a warning, and it's been very lively. But there's other narratives that relate, I think, that help drive the relation between interest rates and or the economy and inflation that come and go. The thing that's striking to me is that people are not very focused on inflation anymore, and some of the older narratives have just died out.
They've just given up, and as long as central banks keep easing,
Well,
then they're happy?
I thought the major innovation was inflation targeting, which has it used to be that people thought that inflation was the biggest problem facing the world, and they thought it was impoverishing them, even though they weren't being impoverished. And that is an important part of the new world that we live in, that people have just turned their attention to immigrants instead of inflation or something else.
Well, if we're talking about different risks, maybe we can talk about trade for a few minutes. It's been seen as one of the bigger risks to the global economy at the moment, maybe the catalyst for the next downturn, and I know we'll come to that in a minute. And I know, Patrick, you don't necessarily agree that trade is the biggest risk. So, and maybe, Bob, you think it's more about the narrative that how people are interpreting it rather than the trade tensions.
Sorry, narratives are on my mind because I just written a book about narratives in economics. Yeah.
So, trade. The next downturn.
If you give me 10 seconds, I would just like to add something to what Bob just mentioned. I think if you're serious, I mean, the reality, of course, if that was causing low inflation, is a change in the way labor markets function.
Yeah.
And I'll take the US today. It's very impressive. If you look at unit labor cost, wages corrected for productivity, year over year, in Q2 this year, they have increased by 1%. 1%. So core inflation is 1.6, which is 1% coming from wages and the rest coming from tariffs and whatever additional causes of inflation. 1%. When you look at the past, at the same stage of the cycle, unit labor costs were increasing by between 4 and 5%. So this is just due to the fact that for many reasons, there are a lot of research on that, firms concentrating, of course, labor market regulations being already made less severe. What we have is a big decline in the bargaining power of wage earners. Central banks cannot fight against that. So when you listen to Draghi, I should not mention that too much, but I think this is a guy, for instance, I think he's wrong in many instances. When you listen to Draghi saying to the ECB, let's say, saying we continue with this policy because we want inflation back to 2%, they cannot fight against the way labor markets function. It's too big. I mean, if labor markets lead to 1% wage inflation, whatever the central bank does, you will still have 1% inflation. So the big issue is that if inflation is due to cyclical factors, then okay, central banks can do something about it. If it's due to this big structural factor that even at full employment, wages do not increase faster, then central banks can do nothing about it. And it's completely useless to keep trying to get more inflation. So now, trade. No. I completely agree. There is a narrative, of course, that you use Bob's book, I mean, which is that since everyone believes that the trade dispute between the US and China leads to lower growth, at the end of the day, you may end up with lower growth. But if you look at the facts, today we have $100 billion of tariffs put in place in the US, which is 0.11% of world GDP. Factually, I mean, you cannot have, and I read a piece yesterday by a couple of US academics telling that, the world this year would lose 0.8 point of growth because of tariffs. You cannot have 0.1% additional tariffs causing 0.8% GDP losses. It's just not possible, except if this is starting a panic and people stop consuming, stop investing, which might be the case. But really, when you look at the facts, you see that the main cause for the economy slowing down is not the tariffs, it's a big and very, very rapid change in the economic model of China. China extremely rapidly is moving from a manufacturing-based economy to a service-based economy. Manufacturing is in negative growth, it's shrinking. Look at cars, look at investment, look at even construction is shrinking. And what's growing is basic services. If you grow through basic services, you don't invest a lot, you don't import a lot. Chinese imports are in negative territories. They have, in real terms, they are down 2% year over year. 1 year ago, they were up 12% year over year. And this is the biggest shock to the global economy. So the fact that China is not an importer anymore and is extremely rapidly, again, moving to services. We were in a conference last week with a number of Chinese economists. It was very funny because there was a question from the audience, is, what do the young Chinese want to do today? And the answer was, oh, no, they don't want to work anymore. That's over. That's for their parents. They want to go on holidays, to go shopping, to go to restaurants, to go abroad, I mean, to visit. And they want to work as little as possible. So so they're becoming French very rapidly. But when you look at the data, it's impressive. Services in China, now it's 55% of GDP. And see, it's the only component of GDP which is growing. If what you develop is services, again, you don't invest a lot, you don't import a lot. And so the positive effect of China on the world economy has just disappeared. And this is a much bigger shock so far than tariffs.
Thank you. Bob?
Yeah, well, the idea that tariffs might destroy the economy has a past history of exaggeration as well. In the Great Depression, there was a tariff at the beginning of the Depression imposed by the United States, the Smoot-Hawley tariff, and it got a reputation as having started a, quote, trade war, and therefore, by some accounts, the major cause of the Great Depression. This was a new narrative. I searched for trade war before 1930, and it comes up during World War I, but it meant the war on World War I being fought on other grounds, namely disrupting the trade of the enemy, so that they can't resupply their resources. So it was a new word in the Great Depression, and it sounded plausible to many people that it would be the cause of the Depression. However, just as Patrick said, it was also exaggerated. We didn't, well, looking at the U.S. in particular, they didn't trade much of their GDP at that time, and it didn't change that much, so it just wasn't a plausible cause. But that narrative still sticks with us, and it was politicized when Trump started the trade war. It was part of an atmosphere of great polarization and hostility, and people wanting to make out that Trump had made a horrible mistake. So it then became a source of real anxiety among business people, and that can slow things down. Paradoxically, Trump has been such an inspiration to more than half of the population in the United States that they continue to spend as if there was no problem. So it hasn't really had a real effect yet, but it's there creating doubters. and it could become worse.
We do have the risk of sort of a self-fulfilling prophecy
Right.
on trade leading to, if not a recession, at least a downturn. While we're firmly into risks now and we're talking about self-fulfilling prophecies, maybe a word on the yield curve inversion.
Right.
We have, I think, had maybe one yield curve inversion in the past however many years that didn't lead to a recession. Is today different because we're in a different world and we've talked about the structural differences, and maybe it's central banks making the yield curve flat or inverted. And could we see a self-fulfilling prophecy around this as
Right.
well?
So I think it's quite plausibly a self-fulfilling prophecy. That is that the talk about the inverted yield curve will cause a recession. So you're getting my latest methodology. I keep coming back to my new book, but this actually isn't in my book. I do a lot of searches for the origins of narratives and ideas. The key theme that I'm pursuing is that the economy changes because people's thinking changes. So I looked up, I did a search to see back 100 years, how often was the word inverted yield curve. Just to remember, an inverted yield curve occurs when the short rate is higher than the long rate. So I found, you go back 100 years, occasionally you'd see in newspapers pointing out the yield curve is close to inverted. Funny thing, period. They had no idea, and I could see that it was a leading indicator. They started doing leading indicators in the 20s and 30s, but they didn't mention that one. It then started to be, now the only time people talk about inverted yield curve is when it's close, when we're almost there. Started around 1970, they started talking about inverted yield curve as an indicator of recessions. And then with each inverted yield curve, there did seem to be a recession after that. And each time the talk got bigger. So it strikes me that it was a only mildly plausible theory before 1970. And then it started a self-fulfilling prophecy cycle. Maybe I'm over, I can't prove that. That's a thought. But now it's just gone wild. Of course, our yield curve is rather anomalous. In some countries, both long and short are negative. So something unusual is happening. And people like to develop news stories that are apocryphal, that talk about apocalypse, are more get more readers than more stable stories. So it's really gone to the point where I think this story could cause the next recession.
Any comment on the yield curve?
Yes, I think we have to, well, I think we have to be very prudent. Because there's always a recession afterwards. So the yield curve did not invert. It was flat, for instance, starting in 2004. And then you had the recession in 2008. So you can say, okay, look, it's just forecasting a recession. It was 4 years after. So you always have a recession. So we have to be careful. But no, I think today, basically what we said before is that the correlation between the cycle and inflation has become very low, perhaps even it completely disappears. And the basic the explanation for the yield curve being a leading indicator of growth is just because if you got more growth, for instance, you expect inflation to reappear, you expect the central bank to tighten, and then you've got long-term risk moving up. In a world where there is no correlation between inflation and the cycle, you should not have the yield curve being a leading indicator. There is a very interesting research also done by the San Francisco Fed on the term premium, showing that the main explanation for the flatter yield curves was that term premium on long-term rates had disappeared because there is no uncertainty on future central bank rates. They are very, very stable. And if you don't have any uncertainty on short-term rates, then you don't have a term premium on long-term rates. And their explanation of the flatter curve is just that these term premia, which are normally added to long-term rates, have disappeared. So I think you can find a lot of rational and consistent with the data explanations, leading to the idea that today the yield curve is not a leading indicator of growth anymore. But you agree with Bob. I mean, you cannot open a newspaper without an article on the yield curve is announcing something very terrible. So can it be the other way around? Can we have a real convincing explanation that a flat curve is actually causing slower growth? And the answer is you have it in Europe, not in the US, because of banks. A flat curve is very bad for retail banks. And there is a very interesting research done by the BIS in Basel on the data for European banks showing that, yes, when you've got a flat curves, banks move out of lending and into different businesses, as asset management and whatever. I mean, and that it has indeed a negative effect on the supply of loans. But in Europe, I mean, banks, in the US, I mean, banks play a much more reduced rate, and companies, corporates are financed on the capital markets. But in Europe, yes, you can find a decent explanation that a flat curve through the banks is weakening the economy.
So if we're talking about recession or downturn, we've kind of eliminated a lot of, well, other than this self-fulfilling prophecy, which I guess then is a lot about investor sentiment and confidence, and if people stop spending, corporates stop hiring, where do you see the next, so maybe where do you see the next downturn coming from? And does it have to look like 2008? Are we going for a crisis, or is it just natural that we're going to have some form of mild or not so mild recession eventually?
Well, you know that economists are not good at predicting recessions. In fact, there is Philadelphia Fed collects professional forecasters' data going back 50 years, and one study concluded that they can forecast out 3 to 6 months, but going out a year, the probability that GDP growth was negative, they've been asking them this question, has absolutely no relation to reality. So we don't have I take that as that the recessions are more of a psychological thing. And behavioral economics, while it's been a revolution, hasn't really addressed the cause of recession. So it's an embarrassing position for economists in general that they don't have a explanation of something so that allows them to forecast something so basic. So it's the same thing as, much the same as forecasting the stock market. You'd think that big stock market moves would have explanations, like what happened in 1929, the biggest ever. Why? People have scoured newspapers for the day of the 1929 crash to see if there must be some news story they were reacting to. But the answer is no. The only news story they were reacting to was stock market declines the preceding week or the preceding month. So there is a deep psychological component to these things. Now, in the United States, where I live, it is just amazing how Donald Trump has dominated our thinking. And where I live, it's geographical, too. So it shows something, direct word of mouth is important. Where I live, it's hard to find any Trump supporters. But when I call home to my relatives in Detroit, they're all in on Trump. It's a little bit of friction. But I think that part of what's this sounds unprofessional for coming from an economist, but part of what's been driving us is a Trump effect. Well, it's not. Trump didn't invent it either. He is an astute studier of public opinion, broad masses of public. He listens and he knows what is on their mind, and he then uses it to his advantage. So there is a sort of willingness, wish to believe that capitalism is America's genius, that you have to live the American dream, that people who are poor, they should go and see your house. It's beautiful. They can have it too. This is a country of opportunity. Anybody who really tries can get rich. If you don't believe that, buy Donald Trump's book, How to Think Like a Billionaire. He is a motivational speaker. And I don't know how sympathetic you can imagine yourself feeling to this sentiment, but it is a nice feeling that in America we can all be Donald Trumps if we. And even people who despise him, I think, may be influenced. There's sort of a sense now that I can spend, and it's the thing to do. But now the question is whether this could turn in the next recession. So his narrative has been going for 50 years. But he's got more enemies than ever before who are trying to start narratives against him. They've tried, and there's been so much raised against him that you would think he'd be gone by now. But his narrative is so strong, and it's actually driving the U.S. economy. But I think that history shows that the public can turn on their previous inspiration. Think of Mussolini, for example. It happens, and it happens after. The beginnings of the next recession could be a point when other narratives start to take hold. It's a psychological thing that, I'm uncomfortable still after having researched it a lot, still saying, but I think that it is possible that there will be, that he will not get reelected, and it'll be a recession that pushed that. And then it will be a whole new world because the sense of power and opportunity will have changed.
Yes, just to try to complement that, it's very interesting. So a lot of people doing research on social mobility, and it's very interesting because in the US, the Americans, social mobility is basically if your parents are poor, can you be rich? You measure it factually by the relative income of the kids to the one of the parents 30 years before. And in the US, the Americans, when they're asked, they think that there is a very high degree of social mobility in the US, and that it's making them accept inequalities because they think that their kids might be very rich. And in reality, social mobility in the US is very low. And in France, people think that social mobility is very low, so they reject inequalities, and the reality is that social mobility is rather high. It's much higher than in the US in reality. So the perception of social mobility plays a very big role in the acceptance or not of inequalities. So that, I think it's very important. If I look at the non-psychological causes of a recession, I repeat what I said before, I don't believe at all that we can have something driven by debt. With zero rates, you cannot have what we had before, a debt-driven recession. I don't believe that can happen, so you have to look for different causes of a recession. And I mentioned already China. I think China is a real one. World trade is going now by 2%. The exact figure is 2.1. It was going by 4% 2 years ago. That's a big shock. You've got old style, manufacturing, like cars, like chemicals, like equipment goods shrinking. Look at Germany. So countries with a big exposure to that old manufacturing are in very severe difficulties. This includes countries like Korea, for instance, if you take a look at different continents. But you cannot have, I don't think you cannot have a real crisis. A crisis is always associated with a problem with debt, people being too much in debt with higher rates and being unable to service their debt, having to cut their spending. I don't really see that happening. Just a word also on the presidential election in the US. I think this is a very, very important issue. Basically, we are looking for something that could cause inflation to reappear. As long as you got low inflation, we'll keep low rates, and then people can keep borrowing more. Debt ratios can keep increasing with basically no cost. The day inflation starts being higher in a substantial country, you're in a different world. If you look, I look very carefully at the programs of the different candidates from the Democrat Party. If you look at, for instance, what Elizabeth Warren is proposing, would certainly end up is much higher inflation. If you stop the US from producing more shale oil, which would cause a big imbalance on the world oil market and oil prices, if you double the minimum wage, if you increase public spending, and you increase all sorts of taxes, you might end up, it's very hard to estimate, but there's a doubling of the minimum wage to $15 per hour, for instance, by itself could take inflation to around 4%, probably, according to my estimates. If you got 4% inflation, it's very hard to see the Federal Reserve not reacting, and then you're on a different world, with basically back to the 70s, 80s, with larger wage growth, higher inflation, higher rates, and the limits to borrowing. So I think what will happen in the election is very important. Perhaps we like idea because we are always asked by investors, what do you think could cause inflation to reappear? We have no unemployment left and inflation is still very, very, very low. What could cause more inflation to reappear? The only answer we have is a shock in politics. In a large OECD country, a new government having a completely different labor market policy. This could be the cause of higher inflation. I don't see any endogenous cause for inflation being present today.
Okay, so we've talked a lot about the economy, and I appreciate I am with two economists, but can I try to take you a little bit into markets? We've seen, and quite generally I'd say, we've seen this dichotomy where bonds are rallying, which might be an understatement, and equities continue to do quite well, not as well in Europe, but particularly in the US. How long can both, in the context of whether it's trade, no inflation, central bank support, how long can they both be right? Or are they actually just painting the same picture and it's a new normal we're in?
Well, it's not the same picture. It always changes. But I think that we're not in, there were two major stock market peaks recently, one sort of recently. One, people call it the dot-com bubble, but I like to call it the millennium bubble because it wasn't just dot-com stocks. And we saw the stock market get amazingly high. The CAPE rate, this is my ratio that I've been promoting for years, which is price, real price divided by a 10-year average of real earnings, reached 46 just at the dawn of the new millennium, around 2000. It's only at 29 now, so it's not anywhere close to that all-time high. Similarly, for home prices didn't peak in 2000. In the U.S., they peaked in 2006. And if you look at price to rent or price to construction cost, it was a similar, huge, almost unprecedented peak going back, over 100 years. So something unusual was going on there, but it's not anywhere close to that now. Although home prices have been rising in the United States. So if you go back and look at prior to the Great Recession, as we call it now, in 2007 through 9, there was preceding that an atmosphere of really bubble thinking and enthusiasm for investments, especially in real estate. And there were new narratives appearing that made it look easy to make a lot of money by, the new term was flipping houses, buying and selling quickly. And these were everywhere. I would taxi drivers would tell me about the housing market. And I didn't even ask about it. They don't know who I am. So that's a sign of something anomalous going on. And we're not really there yet. We're not back to those moments. So yes, this could go on for quite a while. I don't see any, this inverted yield curve talk is maybe the biggest single negative indicator, and it is a new narrative. We could see something else appear, but it's hard to anticipate. It's like trying to predict the next hit song or the next hit movie. I can't imagine the narrative at this point in time that would make it come to an end.
Okay, and bonds can keep rallying? Central banks are
Well,
just going to keep yields?
they can't, long bonds can't go that much more below zero in their yields. Then people start holding cash instead. And that could be itself a new narrative, that people are doing that. So it will stop them. They can't. It is a real puzzle. It does, that long rates are so low, out to 30 or 50 years. I think in Switzerland they had negative.
Yes, as a Swiss person, yes.
Yeah.
Everyone wants to be like us, and just you can go out 15, 17 years before getting to zero.
There's something anomalous about that, someone will figure out a way to profit from the discrepancy. It shouldn't be negative. Something is amiss. We may see changes that will prevent that from continuing.
Yeah, two things. I will look more at the European markets and more on the US market, which Bob did a minute ago. In Europe, two things. I think the central bank and a lot of economists are more and more aware of the cons of having negative rates. Again, yesterday I could write a list of 14 very adverse consequences of negative rates, including people invest in money. We see M1 just skyrocketing. People invest in property, and we have a property bubble restarting in Europe. People find a very interesting thing. Banks find as zombies, these companies which do not disappear. And there's a very fascinating piece by the BIS in Basel on why do we see banks preferring financing zombie companies rather than good companies. And the explanation is very interesting, because if you stop lending to a good company, it will survive. If you stop lending to a zombie, it dies, and then you've got to provision the zombie in the accounts of the bank. So you prefer to lend to the zombie. And so all of that, and I could continue, there's a very long list of that. All of that, you're weakening banks, insurance companies in a tremendous way. So all of that is leading in reality to lower long-term growth, to lower potential growth. And I think more and more we see that there is a very adverse potentially effect of these policies on growth. So I think what we'll see in 2 days might be the last move towards easing more, I think, because even inside, perhaps you have read what Christine Lagarde has been telling to the European Parliament last week, and she says at some stage, I'm very aware of the many adverse consequences of this rate policy. So we might see the ECB, as time goes, when all the madmen today have gone, moving to a more reasonable stance. And now, in Europe, when you look at the equity and bond markets, the situation is quite different from the US, because what's hard to understand is that investors have not been what we say rotating from bonds to equities more. You've got negative rates. Rates are way under growth rates, interest rates, and so normally investors should have just been selling bonds a lot and investing a lot in equities, and they do exactly the opposite. When you look at the net flows, investors, both domestic European investors and foreign investors, are bond buyers and equity sellers. So today they rotate from equities to bonds, which is very hard to understand. I mean, when you look at the level of rates. Now we know what's going on, and again, there is a lot of research on that. What we have is an extremely large increase in the risk premium, so which you don't have in the US. If you look at the risk premium on the Euro stocks today, it's 6%. Before the 2008 crisis, it was 2%. So you can do a very simple calculation. You calculate the discount rate used to discount future earnings. So before the crisis, you had 2% for the risk premium and 4% for the 10-year rates. So 4 plus 2 equals 6 for the discount rate. Today, you got 0 for the government rates. I just make that round, and 6 for the risk premium. So 0 plus 6 equals 6. So we got the same discount rate as before the crisis. So this is explaining that equity prices are not higher in Europe than what you had before the crisis. The PE ratio is still around 14, because the increase in the risk premium has completely offset the decrease in risk assets. And there is a very interesting research done by a number of people, including me, by the way, on this, but for corporates. If you look at the return on corporate capital in Europe, is exactly the same as before the crisis, but it's true in the US as well. It's 5.2%. And so normally, if you got much lower rates, you would expect that the return on capital goes down as well, which would mean more investments, but no. So the risk premium on investing in the capital of European corporates, but on OECD's corporates, has increased exactly the same as rates have been going down, and so we don't have more investments. Because the required return on capital is still exactly the same as before the crisis. So I think there is a very interesting story on risk premium. So basically, these lower rates have been completely offset by an exactly corresponding increase in risk premium.
I might add, the term risk premium is unknown to the general investing public, I believe. It's an academic construct, which they're telling a completely different narrative. I don't mean...
When I show a chart with equity of risk premium to European investors, at least they pretend they know what it is.
Okay.
Smile
No,
and nod.
It just seems to me that they tend to think in new records. So this is what's on the mind of, I'm thinking of U.S. investors again, but the stock market in 2018 had a big a correction in January, February, And they thought, is this it? We've been talking about a highly, I know I do surveys of American investors. They have been thinking the market is highly priced. So, but then it somehow it stopped falling and it went back up and set new highs. And then it went down again at the end of 2018, big drop. And it looked like this is it. But then it went up again. So it called up an old narrative, which is much more simple-minded. It had a nickname in the Great Depression, or no, I'm sorry, in the 1920s, the bull market of the 1920s, and it is the market goes one step down, two steps up, one step down, and two steps up again, and that repeats again and again. So I think people they're just thinking we had these two scares. We're in good hands with Donald J. Trump. He's pro-business. The whole world is getting pro-business. It goes there, and then there are others who invest in long-term bonds, no matter what, because their grandfather told them to do this, and they're thinking ahead to their retirement. And these are what's driving. It doesn't have a lot to do with expectations of what the central bank. In fact, they don't even know what the central bank does. I remember my friend Jeremy Siegel, who, when he took his job as a young student at the Federal Reserve, they were being given an introduction to, as new interns, for what the Federal Reserve does. And Jeremy got the idea that the woman who was speaking to them didn't know that they print the money, or that they direct the printing of money. And so he asked her some pointed questions and concluded she doesn't understand the Fed at all. And here she is lecturing to us. It's a rarity that people think in economist terms. Listen, I think you have an element of truth to what you're saying, but I'm saying there's the other side of the great unwashed masses who'd like to watch Donald Trump because he's fun, and he always talks about making America great again, and that's it. That's where their thinking ends. They just they don't have expectations.
You know, well, that's where the US are very different from Europe, because you've got a lot of individual holdings of stock in the US, which is not the case in Europe. It's very much professional holding. So when you discuss who is investing in equities in Europe, it's professionals. It's
right.
Asset managers, insurance companies. In the US, it's a lot of individuals, and they have their 401ks, and they have to look at the stock market. So here, Europe is very different, I think.
I mean, going with investments and markets, but we are at the kickoff of the UN PRI conference. So I thought maybe, where are we in the beginning of responsible investing, of ESG? How much more work? I know Patrick thinks we have a lot more work to do as we get there, and Europe is definitely in advance compared to the US, but maybe can I get some thoughts from each of you on how that's going to drive future investing, I guess, especially for the next generations?
Okay, so ESG investing is a new... I'll come back to my book. I'm sorry, it's on my mind. There are perennial narratives that return, that come back. And one of them is, and they tend to change their name as they're reborn. So ESG is the newest name. And it doesn't go very many years back. But before that, we had SRI, socially responsible investing. And then we had ethical investing. And I was just talking here about you were contributing, I guess. What did they used to call it before? Ethical investing goes back to the 1970s. But we thought of Christian investing, but no, that's not what they called it. I think there was abolitionist sentiment. I thought maybe boycott was the word. They would be boycotting unethical companies. I have to research this further. Boycott was a new narrative that appeared in the 1870s, and suddenly by the 1890s, people were boycotting all sorts of things. So they must have been boycotting stocks of unethical companies. So it's a new word for. Obviously, you think about the morals of the company you invest in, but it's become a new narrative as or you call it a social movement lately. And I'm applauding it. It's great to see why it happens. But it's generally hard to see why it happens. Any explosion of a social movement, the causes of it are something that's increasing the contagion of the ideas, and those are often subtle and hard to pin down. We don't have a real science on them. But I welcome the attention to ESG investing under a new name, and so it may also be a successful way of investing, because instead of trying to judge the blurb that the company puts out, you judge them by their ethical behavior. And that may actually be an investment strategy that works. I think it is.
Yeah, just to, I think, well, just don't want to repeat anything. I think we have still a lot of work to do on that. ESG investing, I think, has to become dynamic, not static, but it's very complicated. Take the example of a tobacco company. So you don't want to invest in a tobacco company. So you're asking the tobacco company, what will you do in 30 years? And the only answer is tobacco. If you speak to an oil and gas company, they can tell we'll do renewables, green electricity, whatever. So some companies can change their business model, some companies cannot. What would be right would have to this dynamic ESG rating, which would say we want these companies to respect the 2-degree increase in temperature rule we decided internationally. So what do? Do they have a business plan to change their CO2 emissions over the next, or their business model over the next 20, 30, 40 years? Cannot be next week. Cannot ask to Shell or BP or whoever to stop producing fossil energy next week. It has to be dynamic. You have to ask to these companies, what will you do in 40 years? So I think the first task will be to have some form of dynamic measurement of forward-looking, something like forward-looking ESG. That's not easy. There's some progress done here. Second thing, and this is kind of thing Ossiam does, I mean, it's not only, the global score is not very interesting. When you look at what's efficient for investors, is looking at the details. So go inside the sub-indices, inside E, inside S, inside G. Got a lot of information in the sub-indices. Currently, I think there are like 130 something sub-indices or even more. There is a lot of information not sticking to the global score, but looking at what really matters. So here again, I think you've got to do more research. So I'm convinced it's very powerful. I'm convinced that it's more powerful than governments or regulations, but the financial markets and investors play a bigger role in changing the behavior of corporates and the governments. There is no law in France making it that a company has to restrict its CO2 emissions. It's investors forcing that, so it's very important. But it has to be made sensibly. I was in a conference 2 weeks ago with a number of NGOs, and the main demand was banks and investors have next week to stop investing $1, whatever, in fossil energy. You cannot do that. You know that the first stage, for instance, is to replace coal by natural gas. If you want to replace coal by natural gas, you've got to invest more in natural gas, not less. But then, of course, you've got to stop investing in coal. So you've got to be sensible in doing that. And again, I think, very much forward-looking.
Thank you. Before I open it up to questions, I'm sure there are plenty. Is there one last thing that's on your mind that we haven't covered this morning so far? That was not planned. Trick question.
I've just written a book. You buy my book. Yeah, so what I just put another thought in, that I think that the economics profession and finance profession will change a lot in the next decades. And in particular, it's because of trying to get closer to what people are thinking. We have a new data set now that is very powerful, and it's the digitized human speech that is being is made searchable. And so I'm really into this now personally. I'm always thinking of any economic concept or business concept as some kind of epidemic that went viral. I have maybe exaggerated enthusiasm for this at the moment, but I think it's a gap that the econ and finance professions have missed. Most social science, all the social sciences outside of economics talk about this more, and journalists talk about it. We're expected to make it into more of a science, and that appears daunting. But we've got so much computing power, and we can search so many different things now, and we're improving our semantic search, or natural language processing. So I think this is the next revolution in economics. And it will help us understand the issues that we were talking about today. And there are probably people in this room who are doing this already. But changing our scope away from analyzing government-assembled statistics, aggregates of one sort or another, and looking at individual thought and communications.
Thank you, Patrick.
Something completely different, which is antitrust. We've not been discussing that. I think there is a lot of people thinking that we, in the US in the last 20 years, something very important happened, which is that we have monopolies back, that the philosophy of antitrust has completely changed. So the idea that in some cases, very large monopolies can be an efficient way of producing. It's not only in IT, and in all the industries. So there's a lot of colleagues, I mean, Thomas Philippon at New York, or working on this question of concentration. Concentration of companies have been increased a lot. So I think this is very important for the future also of the markets, whether there will be a reaction against that or not. So people tell about splitting Google. Will we do that? The way it was done in the 80s, for instance, by Donald Reagan. And a second issue is that antitrust in Europe so far is very different. It's still rejecting, I mean, that you got that large companies being just created. And look at what happened with Alstom Siemens recently, as the Commission says, no way you can have a monopoly in Europe in this industry. So I think for antitrust for me is a very important issue, and it explains a lot, probably the fact that you've got a very big increase in concentration in the US is explaining a lot of what we see on inflation, on profit margins, on stock markets. So I'm looking at that very closely. What will happen with antitrust policies, and will they converge between Europe and the US, or will they stay very different?
Thank you. Bob, Patrick, thank you very much for your time. And I think we do have some more time, and there should be a mic somewhere in the audience for any questions you might have. Please.
Well, thank you for the inspiring speech. For you, Professor Shiller, in the 80s you wrote a paper, I guess you were also criticized by that, where you say that stock market moves too much if you compare with the dividends. And if you were to write it now, what would be the narrative behind this kind of huge movement around the dividend? And Patrick, for you is, I agree with you with the trade and the effects on tariffs is limited, but is it possible that corporates and planners are thinking that perhaps the US and China war, let's say, is not something that will be solved with a peace treaty? So they are thinking of what's going to happen in the next 30 years. Probably supply chain will be shorter. Probably they need to wait and see how it goes. So this is probably slowing down spending in infrastructure and capital spend. Thank you.
Okay, you're referring to, I'll start, yeah. You're referring to an article that I wrote in 1981 that said that all the tests of efficient markets, which are construed as supporting the hypothesis, missed an important fact that the market is just too volatile to be explained by subsequent dividends. A present value of dividends has a smooth growth path, pretty smooth, and the market jostles all up and down around it. So then the question is, what is the narrative? It's not one narrative. It's again, a constellation of narratives that drives the market. The stock market was first discovered in 1602 in Amsterdam when they set up a stock market that you could actually trade daily, and there were daily reporting of, there was only one company, it was the Dutch East India Company at first. But it excited talk about what is this company and what is it doing? And the prices reinforced the talk. So suddenly the Dutch East India Company was on everybody's mind, and it was pursuing an aggressive, rapid growth. It was a growth stock right off. And so you would get stories about other people who made a lot of money. It didn't take very long before the speculative spirit moved to the tulip market. You've heard of that. Tulip mania, as it's been called. And then newspapers started picking up. They had the first free press was in Netherlands. But what they discovered about investors is this is an engaging story. You can tell stories about other people who made more money than you did all last year on one trade. And the corporate leaders started to become celebrities. And this same basic narrative has repeated itself in both a stock market and housing market and now other markets. If you allow rapid trade in and out, free trade, you can get in and out in less than a day, and you have daily news, and you have newspapers reporting it. It's just a perennial narrative. Now, it was thought to be evil for a long time. After the 720 stock market crash, for the Mississippi crash, it got a bad reputation. But later on, people began to think that maybe this is another narrative about these crazy oscillations in the stock market. They're actually bringing in capital to entrepreneurship. And it was controversial at first, but government started supporting stock markets as a growth, as orienting the public toward thinking about business. And that's good for long-term growth. So now it's everywhere. Even communist China now has stock markets, because it's the power of a narrative that sometimes is disruptive, but at other times seems to get people, their animal spirits moving, and things happen.
Just one sentence, I'll show you. Still, if you look at the US data, the stock market is disappearing. We have 8,000 listed companies 15 years ago, got 3,500 today. Companies are buying back their stocks. So far, I think one of the big issue with volatility is that the stock market shrinks. So of course, this ends up in more volatility on prices. So there's a big question mark in the US, which is why do we have basically the economy moving to non-listed? Which, just to close on your question, you've got two versions. I mean, that the US and China are looking for a compromise. That in few months we have a compromise, that the Chinese will open their markets and that the Americans will cut their tariffs. And this is basically what today investors have in mind. Or, the famous two-seeded trap, that the US reject China becoming the world #1 power, which by the way is already the case, and that you end up in a war between one way or the other between China and the US. It's hard to know. I think the Chinese want to be completely autonomous in terms of technology. They will be in very few years. And perhaps the US just have a very negative reaction to that. So I'm still thinking that in the short run, they keep looking for a compromise, even if it's messy. But it's hard to know if it can get worse at some stage. There is certainly around Donald Trump a number of people who are extremely anti-Chinese, which are telling to the president, you have to stop the expansion of China in Asia, in Africa, you have to make something that they don't catch up technologically so fast. You cannot avoid it. So I think at the end of the day, the Chinese, they spend more than 2% of their GDP on R&D, and the GDP of China is, in PPP terms, is above the one in the US, so they do more research than the US. So they will catch up. So you just cannot avoid it. But look, reread Thucydide. It's very interesting. This is how Sparta was killed.
Thank you. One last question. I see a question at the back, and then we're going to wrap it up.
Good morning, and thanks for your very interesting responses to many topics. There's one topic that hasn't been alluded to too much. We've talked about the structural changes in China, which probably have explained a significant part of the slowdown recently. We haven't alluded to Germany, and maybe its responsibility in the situation of Europe, the European economy, and also maybe the European fixed income market. Do you see any potential changes in the way budget surpluses could be used by Germany, and can it be a game changer for the European fixed income market?
I'll leave this to you.
Well, I just mentioned that Germany would probably have a weak economy for a while, because if you are very good in diesel autos, plastic, and equipment goods, of course you're in trouble. And France resists better. What's very funny, I know, that France resists much better than Germany, just because of the weaknesses of France. If you got no manufacturing left, you cannot have a manufacturing crisis, basically. So Germany will have a weak economy continuing, also a problem with costs. Wages keep increasing by 4% and productivity is completely flat. So you're right that the perception in Germany on fiscal policy is changing. More and more people accept the idea that they should spend more on infrastructures, on R&D, on renewables. Two questions here. Not everyone knows that Germany is the country financing the US. If you look at the foreign holdings of treasuries, until 2013, the new issues were purchased by the Chinese, and since then they are purchased by the Germans. So if you got more public spending in Germany, you will have less savings available to invest in treasuries, and you could have a tension, curiously enough, on the treasury market, because it is which is a shame, by the way, but the excess savings of the Germans, instead of being invested in Europe, are lent to the US Treasury. So Trump can cut taxes using the money of the Germans, which I think is incredible. So yes, it may have a slight effect on the rates if you got more public spending in Germany. B, it won't go very far because they will respect the rule that they have to almost balance the structural budget. So of course, if you got a slack in the economy, you can do more than that, but it won't go very far. So they discuss creating an investment fund of 25 to 35 billion euros, which is like 1.5% of the GDP of Germany. So there will be some fiscal stimulus, but not a big one. And three, their basic problem in Germany is to really change their model. You've got to move to electric cars, to renewables, to IT. So they have to build a completely different economy, which is, and this is where they should invest more public money in doing that, not only on stimulating the economy in a short-term perspective. But yes, they are in trouble. And this is not very supportive for the European equity market, because this is leading to foreign investors being more pessimistic on Europe and selling their European equities when they see negative growth data in Germany.
Thank you all for joining us this morning. We'll be around for a little while for any other questions. Thank you.
So I'll conclude in a few words. Fabien Labouret from Barclays. One, to present you an apology. We failed to put a banner for Barclays. We have been traveling with Professor Shiller visiting clients. We just came back from Israel, and it was unhandy to carry the banner. And we traded that for sleeping pills and swimming suits, which for the latter we failed to use. Just one thing, you are all obviously very interested in economy, hence the discussion this morning. But as investors, you might also be interested in products. So just one thing, we had a long collaboration with Ossiam and Professor Shiller on developing products. It has been, I have to confess, a walk in the park. Usually in English, you use that expression to say the opposite. But as for us, it has been a walk in the park, a long one. There's been a long collaboration. We started that collaboration with Professor Shiller about 9 years ago, and we launched an ETF with Ossiam back in 2014. So if you have something to take away from this morning, and if you're looking for opportunities, there are a lot of articles suggesting that value investing has been actually quite disastrous last year and the year before. But they're referring that Cape, Shiller, Ossiam or Barclays ETF as a product that has outperformed the S&P by 2.67% since 2014. So there is actually an opportunity in value investing if you do it properly. And we had the chance with Ossiam and Barclays and Professor Shiller to develop something that creates quite a bit of value. So if you need more information, get to Ossiam. Thank you very much.